Hey everyone, it's Rob Keens of goldsilverpros.com. It is Tuesday, April 20th, 2021. For today's video, I want to go back over gold and state the bull case for gold. We're going to take a look at the technical chart and a very special announcement coming from China that I think is very bullish for physical gold demand the rest of this year, and something that we haven't seen China do of late. But it's basically China admitting that they're going to be big gold importers moving forward. That's going to have huge repercussions on the physical market. And then we're going to do an in-depth review of a new gold company I think you guys will be interested in. This is Aris Gold. Big happenings there, lots of news there. We'll go over that in detail. Let's go ahead and get started on the presentation. We'll start with the gold chart. I'll get the share up for you guys. All right, here we go. Back on Start Charts, my favorite charting tool. And we can see here I've blown it out on the long-term chart, at least about a 12-year chart. And again, cup and handle pattern is forming a gold that we have talked about in the last 7 to 8 months. If you've been on the channel, cup and handle is very bullish. The chart in stocks and precious metals, basically in any sort of any asset that you want to chart over time. Here's the cup. It forms a little cup formation when you have a high, particularly an all-time high like we had in gold at 1900 in 2011. Then it bottoms out and then it comes back on heavy volume. We got here heavy volume, and then there's a retracement down to some point, and it forms the cup the handle on the cup pattern. Once you get this handle and you've had all this consolidation, all this profit taking, all this consolidation of positions, then if the fundamentals for that asset are still there and very strong, which they are for gold, which we covered in a lot of detail, then you have the next bounce up, the next big move in that bull cycle. And it's incredible on gold because it's happened since 2011. This started with the previous all-time high for gold in nominal dollar terms at 1900 in 2011. We got back up to about 2060, 2070 last year, and then it's fallen back down. But the fundamental reasons for gold are still strong. We had record amounts of negative interest rate debt. In fact, the last time we were in a gold bull market, we didn't even have a thing called negative interest rate debt. It didn't exist, but it exists now because countries need to be able to lend at negative interest rates so that you actually pay them for issuing that debt, because it gotten to the point where they can't afford to pay positive interest on more debt. So more negative interest rate debt. You have got a lot of printed currencies, trillions of dollars in printed currencies around the world. Everybody's doing it, the fiat currency money game. You also have as well declining gold reserves. So gold is getting harder to find, and therefore it becomes even more precious. Same thing with silver, even to an even greater extent. And you have things like the US government issuing a $2 trillion, almost $2 trillion infrastructure program, followed up by another what they think is about 2.4 trillion in the same year. And they're talking about even maybe a third one. So unprecedented spending by governments on a level never seen before in human history. That's basically the bull market for gold from a macro perspective, and then also from a reserves perspective. Of course, we have that gold cliff coming up. We believe it starts about 2027, 2028, and really hits hard in 2030. And that has to do with the amount of proven and probable reserves falling off a cliff. So any gold company that finds a sizable amount of gold that's going to be producing it over the next 6 to 10 years is going to do very well, because there are going to be gold shortages compared to what we have now. So I'm going to go to a shorter range version of this chart, and I'm going to show you the retracement we've had. So this is the handle pattern that we see. We were in a range from, I would say, coming down from about August to December, and then after the election result, some uncertainty there around the elections. Of course, we saw what happened then. We had a little pop up and then a pullback down, and we've had a bull flag form here, and then that predicted an uptrend in the gold price. That's exactly what happened around the third week of March. We had a pop up out of that bull flag trend, and it came back down momentarily, and it came back up, challenged the 50-day moving average and popped through. It still hasn't challenged the 200-day moving average. So I'm not ready to call the resumption of the major gold bull market yet. I still think that gold could drift back down a little bit, maybe high 1600s temporarily. But if it does, that just means we have a fully formed handle on that cup and handle pattern, and the bounce back is going to be even higher. If you want a deeper technical analysis of what's going on in the gold and silver market, you can subscribe to the paid newsletter on our site, goldsilverpros.com. We produce every quarter the Golden Quarterly. I just produced the second Golden Quarterly of the year. That is the spring edition. And I break down for both gold and silver in great detail what these patterns mean and what to expect over the next quarter and over the next 6 months. So definitely tune into that and subscribe to that newsletter if you're interested for that information. I wanted to pop back over here to the CFTC report. This is a commitment of traders from the CFTC, the regulator of these markets, the Commodities Futures Trading Corporation. And we look at these COT reports because it gives us trader positioning. And I just wanted to give an overview of where we are in gold. Overall, we've had a reduction in shorts from the producers and merchants from their short positions, presumably because they're either wanting to roll some of them to a future month to hedge future position, or they feel as though they're bullish on the gold price and they need to have less short hedges. So the producers and merchants have done that. Overall, the swap dealers of the bullion banks have gone net long too. They've added 1,778 long contracts and dumped 674 of their short contracts. So it seems like we have a little bit of a long play going here in the gold market, and that seems to coincide with this little price movement that we've had here in the gold market as well. Overall, the bullion banks, the swap dealers still own 47.9% of the shorts, and the producers own 33% of the shorts. So concentrated positions from the producers and the bullion banks there. That is the CFTC report for you guys. The big news, the really big news that came out on April 16th, about 4 or 5 days ago, exclusive from Reuters, not really because other people are reporting it, but China opens its borders to billions of dollars of gold imports. Why is this big? Because China, for the most part, was sort of a closed market in a lot of respects. China would produce a lot of its own gold. Certainly, there would be some imports of gold for the consumer market, but what they've done is open it up big time in the commercial sector. And this is new. This is something big for China. Now, we've been saying for years here on this channel, China is going to be a major gold player, and they may even take the reserves, not only in their central bank, but in their sovereign wealth fund, which is where they're hiding a lot of their reserves, so they don't have to report on it, but they have admitted to doing this. Combining that together may be helping support the currency in the new system, the new Basel III requirements, in which gold can be one of these top tier assets in terms of it's as good as cash, as long as you hold it in allocated form and you do your price hedges on like a futures market or OTC market. So gold is going to be a bigger player in the banking system, especially the central banking system going forward. And China could use a lot of this gold to help bolster that as an asset on the balance sheet of their central banks. Well, now the commercial banks here are opening up to import of gold as well. It says here, China has given domestic and international banks permission to import large amounts of gold into the country. 5 sources familiar with the matter said, potentially helping to support global prices after months of declines. China is the world's biggest gold consumer, gobbling up hundreds of tons of the precious metal worth tens of billions of dollars each year, but its imports plunged as the coronavirus spread and local demand dried up. With China's economy rebounding since the half of last year, demand for gold jewelry, bars, and coins has recovered, driving domestic prices above global benchmark rates and making it profitable to import bullion. The local premium is now about $7 to $9 an ounce, according to gold traders in Asia. About 150 tons of gold worth $8.5 billion at current prices is likely to be shipped following the green light from Beijing, 4 sources said. So an additional 150 tons going into China because of demand. Now, I don't think it's all industrial demand, because most demand for gold, unlike silver, is actually in jewelry form or in other investment form like coins and bars. So a lot of this is investment demand. The bulk of China gold imports typically comes from Australia, South Africa, and Switzerland. Of course, Switzerland does a lot of the refining. The People's Bank of China, the country's central bank, controls how much gold enters China through a system of quotas given to commercial banks. We've had no quotas for a while. Now we're getting them most since 2019. The size of the shipment signals China's dramatic return to the global bullion market. Since February 2020, the country has an average imported gold worth about $600 million a month. In 2019, its imports ran about $3.5 billion a month, or roughly 75 tons. So big news from China, lots of gold import. That's going to put some strains on the short term on the gold availability. And that tells us that China's really looking to gold from an investment perspective and jewelry perspective. The retail market uses jewelry in their ceremonies. They use it for long-term investment, handed down from generation to generation. That's a big part of Chinese culture. I know because my wife is from Southeast Asia and is part Chinese, and that is a part of her culture. So I have specific anecdotal experience with that, as well as just knowing that's part of Chinese culture. So that's a big thing. But I think a lot of it's going to go into the hands of their banking system, partly because of Basel III requirements, partly because they realize how important gold is and they want to have it. That's big because China's a big player on the international stage. We've seen, Hungary and Germany and stuff try to repatriate their gold. This is a bigger boy. China is a bigger boy. going after the gold, importing it to their country and opening it up. That's big news. All right, on to the company I wanted to talk to you guys about. This is going to be Aris Gold. Aris Gold is a really interesting company. We're going to talk about, I'm going to walk you through their presentation, talk about the value proposition here. A lot of you guys email me all the time about the mining stocks. I like to bring you guys mining stocks. We just profiled 2 in-depth profiles on our quarterly newsletter that I mentioned earlier in the presentation. So if you want to become a paid subscriber, we do a deep dive on those 2 companies. One is a gold company, one's a silver company. Both of them, I think, are potential outstanding investments for a portfolio. Of course, do your own due diligence, please. Work with your financial advisor, but I like to bring you guys good prospects. Well, I've got another one here for you. Aris Gold is potentially, well, not potentially, is going to be a big boy player in the gold market. This is one that's already producing, that's about to get bigger. And boy, wait until you see what they've done. They have got just an absolute, just exploded their management team and did a lot of other things to really enable them to become a really big target in the marketplace. And they're going to attract a lot of capital. They've already attracted a lot of capital. They're going to attract more, and wait till you see what their production schedule looks like and what they're going to be pumping out in terms of ounces. That's the really good news. So here we are at their presentation. I'm just going to skip down. The first thing I wanted to do was bring to you who's involved. So they've had a management change here, not only at the management level, but the board level. And we're talking some major players. So select companies that were founded by their current management board included Goldcorp, Yamana Gold, Wheaton Precious Metals, Gran Colombia Gold, Legal Mining, and Endeavor Mining. So big names in the gold space have converged on Aris Gold to lead this company. That's huge. They, as it says here on the slide, they built companies before, they know what they're doing, and this is big boy gold. So this is definitely an interesting company. They started acquiring assets, started with, well, this is how they're going to do it. They're going to do it like Legal Gold Mining and Endeavor Mining. And Legal Gold started with the acquisition of Los Filos in Mexico. Endeavor started with the acquisition of Estrucan Resources, or the Yuga Mine project. And so that's the strategy. Acquire an existing asset, build out that asset, and then go after more. And it's going to be a multi deposit company. They've already got more than one deposit, and we'll go through that here in the presentation. So their biggest asset's in Colombia. It's a producing asset in Colombia. It's the historic Marmato mine, which consistently operated as a simple non-mechanized cut and fill stoping operation, mostly at service or a little bit of depth, not major depth, going after the sort of the easier gold ounces there. That mine is still producing. They discovered a large porphyry mineralized zone below that at depths, which is where a lot of the new gold is coming from. The upper part of it's called the upper mine, and then you've got the lower mine. So they have now delineated a 2 million ounce reserve, and that's a proven probable. Reserve means proven and probable. Very high percentage chance that they're going to get all that gold out of the ground. And then in addition, they've got resource, 4.1 million ounce measured and indicated, and 2.2 million ounce inferred. So we're talking, again, big boy gold project. They completed their pre-feasibility study for the lower mine project. That's the new mine project. So they've got that out. So there's no mystery about it. They've done their homework. It's in the pre-feasibility study. All of the detail is there for you. If you want to go to their website, you can get that document. They've sourced almost $300 million in funding. So they're fully funded. And they built out a 30-year mine title extension. So the original life of mine was going to be somewhere around 13 years. They believe they can extend that out quite a bit. So now the new company is called Aris Gold. It's got that leadership team. It's got a long life, low cost, 165,000 ounce a year operation. And you're talking about now a big producer. So some of the highlights from their pre-feasibility study, 2 million ounces reserve, 4.1 million ounces resources, an additional inferred at 2.2, 13-year mine life. That's reserves only. That's not the resources and the inferred, meaning they're going to extend that as they continue to drill out those additional resources and reserves. They can do 5,500 tons per day. There you go. That's plenty of production. 165,000 ounces a year on average. They've got $260 million to get that mine working and in production. And they estimate that the payback on this is by 2026. It's got about a 21% rate of return, although that's going to go higher because those are conservative estimates at $1,400 gold. Of course, we're sitting at almost 1,800 gold down now. It's like 1760, 1770. So that's a very conservative estimate on their paybacks. It's going to be much higher. And their cost, their all-in sustaining cost is about $880 an ounce. Now it starts higher, as you can see on this chart, and gets lower, that's because as they build to depth, they're going to go over some of the best parts or the best finds in that mine as they transition from the upper to the lower, and they start doing the lower as well. So that's why the AISC comes down, starting from year 1 all the way down to especially year 6, and then all the way through year 13, and the production goes up. So production goes up, all-in sustaining cost goes down over time, better returns to shareholders over time. So this is one you want to consider owning for a number of years, because the returns to you, the shareholder, are going to be better over time for that. So they've got the upper mine project, the lower mine project. The upper mine started in 1991. It's between 950 and 1,300 meters elevation. You can see it here in this chart. You see you've got all of those disseminated, not disseminated is not the right word, all those many differentiated veins that they've been working. And here's the mineralization in the lower mine where they get the reserve estimates. You can see there is a lot there in that lower mine. There's a lot that they're showing you there. It's below 950 meters, so it's down there. It's a porphyry mineralization suitable for long hole stoping mining methods, which is just the way that they go down and get it. It includes development of new mine workings, 4,000 ton per day plant, dry stack tailings, facilities, and supporting infrastructure. So that's where that 260 million mine spend is going to come, is building all of that. So a little bit more about what it looks like. You've got the plant, you've got the basically where they're going to put the pads and the waste rock. You've got the camp, the tailing storage over here, the core storage facility if you want to go and look at their cores, and the lower mine workings are going to be below this part of it right here. And then of course they've got an existing access road. So they're not going to have to go build an access road and all that stuff. The money they're spending is on building on that lower mine. So that's good. A lower mine construction began in Q4 2021, and they're targeting gold production there in 2023. By the end of 2023, they'll get that lower mine producing. So that's their plan. It's basically a 2-year plan from now, 2.5 years to get that lower mine in production. So you can be spending that money on that and getting that in production and financing that with the upper mine, plus the money that they've raised. They do have a drilling program from 2020 to 2021. It's still ongoing. You can see some of the finds that they've had: 15 meters at 2.16 gram, 13 meters at 2.89 grams per ton, 78 meters at 3.43 grams per ton. Some really excellent finds, 79 meters at 3.7 grams per ton. So they've got a couple of different veins that they're working on, zones that they're working on. And they think there's a strong potential to blow it outside of 13 years. Because remember, that 13-year mine life is just on proven and probable. It's not on their existing resource and the additional resource they're going to find, because it's open to depth. So they feel as though they could find more. But they've got a 35,000 meter drilling program underway to help continue to identify that. The 2020 mineral resource estimate, again, we've gone over that. They've got the program for 2021. It's in the Abitibi Greenstone Belt. So we're talking about a major mining district. They're not out in the middle of nowhere, mining somewhere nobody's ever done it, having to break ground and having all these unknowns. They're in a place which is, I mean, look at all the mines on the map. And Abitibi Greenstone Belt is well known for its gold production. So there you go. They control over 14,000 acres along a 10-kilometer strike. That's a lot. That is a lot. So here's their timeline. They got the Jubilee project, which we'll talk about here in a minute. They got the lower mine, which is in development. So their development and then further development in the lower mine later on. So blowing out the size of their mine and becoming a bigger company. And they've got another exploration project here in Canada along the way. So they've got additional resource along the way. So they've already identified where they're going to get their additional ounces. And what happens when you go from being a small cap producer to a senior producer, which they're going to be doing with this new lower mine, you get better price to NAV. And what does that mean? Your net asset value is essentially, in a very simple sense, what it's all worth after costs. What's all your ounces in the ground worth after you pay all the costs to get it out? What's that worth? And that's a lot of shareholders' target for what that company's actually worth from like a shareholder perspective. Because when you subtract out the costs, including any debt that you may have, and the cost to get out of the ground, what you're left with is the value of the company. That's what the shareholder should expect the market cap to essentially mimic. But depending on how big you are, there's a discount. So if they go from like a small cap, intermediate cap to a senior producer, they'll realize that full NAV value at that point. The market won't discount them. So what that means is it pulls up the value of each of your share prices. That's what the price to NAV does. That's why price to NAV is one of my favorite measurements, because as companies grow, then that tells you what their worth is going to be from a share perspective. That tells you what your price appreciation is going to be, even if the gold price doesn't go anywhere. Okay. Even if they don't find any more resource, that's a way that you can continue to, your share price will appreciate as you get closer to that 1-to-1 price to NAV ratio. All right. Strong financial position. They've got 32 million in cash, 142 from gold linked notes. These are basically a bond. So that's a little bit of debt. They do have debt on the books, but that will be paid out from partially from the upper mine production, but mostly from the lower mine production. That's just a part of the cost of financing their mines, part of that $260 million mine development plan. So they got $174 million in cash. It's plenty to basically run their program. They have a metal stream from Wheaton. So you can see here, it's Wheaton Precious Metals, 110 million. That's going to help them finance production. This is common. It's a way for a streaming company to get in there and give value to their shareholders by paying a discount to the ounce in the ground for the gold, which helps the streaming company, but it gives a lot of upfront cash to the mining company without having to take on additional debt or dilute their shares. So it's just another way of financing. Companies do it all the time, and it's going to be beneficial to both Wheaton and to Aris Gold. So the current cash is 284. Of course, that completely finances their mine plan, gives them money for some marketing and for some other general and administrative as well. You can see here, Grand Columbia owns 44.3%. Now there is an agreement with them in terms of the ownership. I'll let you read that on their slide here. I won't go into that. Board and management owns almost 9%, other shareholders 33. Orion is in there for 6.3, another Eris-led placement investors. So they're buying their own company, and the previous company has a big investment in that as well, and they have a lot of partners. So that's a good sign. Lots of known entities are invested in this. It's not this huge retail float where they're putting all their shares out to the retail sector. There are shares if you want them, but they've got some big players in there supporting them as well. Looking again at the management team, they built Endeavor Mining and Legal Mining, which is now Eris Gold. They have all of these people in place. You can go down that list. Accomplished people have done it before. They, on the board of directors, they have the former chairman of Gold Corp, another big boy gold company in Telfer. Former CEO of Legal Gold and Endeavor Mining is also on the board. He's also the CEO, Neil Woodyer. Daniela Cambone, you may know her from a certain Kitco and now Stansberry. Former editor-in-chief of Kitco News is in there. I love to see Daniela getting into this because she's been such a fixture for many of us on this side of the house and reporting on these companies and on the sector. It's good to see her being on the board. Definitely a big name there. That's going to help them, obviously, with their image. You're not going to have to worry about their share price from an image perspective, from getting the word out. She's going to be part and parcel of doing that. She's very good at it. Former CEO of Gold Corp and Hudbay, David Garofalo. All these guys, former chairman of Yamana Gold, Peter Marone, he's still the executive chairman. So again, big boy leadership team, big boy gold company. We'll go past that, but they do have health and safety first. They are investing a lot of money into health and safety. That's part of the requirements of working in Colombia, but it's also something that they want to do. And their environmental stewardship, there is a program for that too. So you guys that invest for reasons of social sustainability and want the health and safety of the mine workers, they have programs in place. They're funding those programs in place and using that localized talent and bringing jobs locally to those people. So that definitely helps. And that is a part of the program. And we definitely, actively engage in that community. We want to emphasize that. You millennials that invest in social causes, pay attention to this slide because this company's doing a lot of good things for a lot of people. And that is important nowadays. And they're taking that very seriously, and they have corporate programs for that. All right, why invest in the gold? Company builders, globally relevant gold producer, delivering Colombia's next major gold mine. They've got all the funding they need, and mining sustainability and ecologically safe mining practices. They've got it. So we didn't talk about their other project, but let's talk about Jubilee and Canada. I'm going to talk about this here for a minute. It's an afterthought when people talk about Aris Gold because it's not in production right now. It's the exploration stage of their business, but they're up there and they've got a fair amount of resources too. They've got 733 indicated ounces, 733,000 indicated ounces in one zone. And then, another 1319, another total about 1488. And they're just getting started. This is as of last July. So they're going to continue to work that and increase that. And that's going to be another source of gold for them. So as they're mining out their upper extension, their lower extension, they eventually get this mine built over Jubilee if it makes sense when they do their feasibility study. They've got more production coming on. And again, this is in another tier 1 district. Okay. So they've got 2 good projects. So I wanted to talk about that Jubilee zone. It's a really important one to know about this company. And that's where you're going to get some additional growth from, is that exploration pipeline, which they've already got cranking along. They don't want to just be a one deposit company or a one mine company. They want to start developing these other deposits. And you have to do that. As you mine out the gold, it's a finite resource. You have to replenish your resources. So why not go find those good projects and start to work on them and develop them out of the profits of your existing project so that you can do that long-term value creation for shareholders. That's what they want to do. Going back over the resource and the reserve estimates, The reserve estimates for Marmato are again all the way down here, a total of 4.3 million ounces for the upper mine and the lower mine, including the upper mine transition. That is the proven and probable. That's the highest quality category of reserves. It means you've done a whole lot of drilling and you're really, 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 really sure it's there. Then you go down to the resource estimates, which some people never get to proven and probable. Some people just leave it at resource estimates. This company has both. So they have, let's see, total 11,053 M&I, 11 million ounces. So that puts them at what, about 15 million ounces of reserves and resources. That's not too shabby for Eris. One other thing I wanted to show you guys, I'm going to pop out of the share here for a minute. And all of the estimates about how profitable this company is going to be were basically at $1,400 gold. So let me share screen and show you this. All of their estimates in terms of return to investors, in terms of profitability, in terms of, you know, the net asset value. Remember that slide I showed you about net asset value and how that can be accretive for shareholders as they become a bigger producer. That was all done at $1,400 gold. So let's go and look at that. Their feasibility study for the Marmato project, we're right here on their news release. That's at $1,400 an ounce. We're sitting at about $1,765, $1,770 right now. So their free cash flow is going to be much more than the $770 million they're saying. And so if it takes you $270 million to build the mine, to go make $770 million, you're basically essentially about tripling your money. But that's at, you know, a discount of $350, $360 an ounce. How much does the profit go back up? As the gold price goes back up, it's not going to cost more to build the mine. They're going to still build it for this cost. It just goes straight to the bottom line because that's the profits. What happens when a company's producing more profit every quarter? Share price goes up. That's accretive to the shareholders, and it's leveraged because every additional dollar you get above $1,400 an ounce for each ounce of gold sold, which right now is again $360 to $370 per each ounce, gives the shareholders pure profit, and that is a levered play on the value of your share price. So if you get in now, when you take your position now and they start selling that gold, especially when you get that lower mine extension, 17, 18, 1900, maybe you get back to 2070, maybe you were up to 2300, depending on what goes in the macro economy. All of a sudden, this company is printing money essentially. And that, you know, that makes your share worth more. So that's really the value of this company. It's that they're a really big company, really great management, great district. They've got other projects that they're going to be developing. They've already got their financing. They've got everything that you would want in a big established company that's already producing and is going to produce more. This is the value of Aris Gold. And again, if we go back to the macroeconomic conversation, I'm showing you the technical charts where I think gold's going to pop. We could drift down a little bit, but we're going to come back up. Even if we drift down, it's not going to affect Aris Gold all that much. You're still way above, even if you get to 1680 gold to form that cup and handle, you're still way above $1,400 at the amount of money they're making the pre-feasibility, and they're profitable at 1,400. But then I think gold's going to go back up. I think we'll pass 2060, 2070. That could happen this year, next year, sometime in that range. And then how, you know, what's a share of Aris Gold worth now when you're sitting at 1,900, 2,000 gold, 2,100 gold? That's the perspective of having a large gold producer that's getting your higher price to NAV valuation because you became a senior producer. And so you get that 1-to-1 on your price to NAV, which raises all the share price. And at the same time, you've got a raising gold price because of the macroeconomic environment. You know, and that's what you're really looking for in this type of play in the gold space and in Eris. So again, please do your own due diligence. I'm not your financial advisor. All I like to do is bring you guys the good ideas and what I'm seeing in the marketplace. This one came to me. I looked at it. I said, you know what? I definitely want to talk to you guys about this. Do your own due diligence. If you know you do want to pull the trigger, contact your financial advisor, your broker. You know, make that decision with him. But this one, I had to bring this to you guys. This is such an awesome potential for a stock. I mean, if I don't bring you this one, you know, you guys should email me and say, hey, Rob, why aren't you bringing these type of projects too? So we like the exploration projects, but we definitely like the producers. Those can be stalwarts to your portfolio. All right, so that's going to do it for today's edition of Gold, Silver, Pros. Thank you so much, guys, for joining the channel. Until next time, this is Rob Keats, and we'll see you next time.